Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, July 7th. Short week this week in terms of trading days, only 4 with the 4th of July on Tuesday. What did we learn? What did we observe? Was there any signal in the markets this week? Well, from a positive standpoint, I think you have to be impressed with how the equity market had a bid under it into those higher rates off of some of the news on Thursday. Well, you saw the 10-year rip through 4%, you saw the 2-year through 5%, and there was some pressure on the equity market midday, morning into midday, but there is a bid underneath this market. How long it stays, we don't know the answer to that. But you saw bidding 2:30, 3 o'clock on Thursday. You saw some slight weakness Friday morning. A bid came in again. So it is important for us to at least realize and recognize that there is demand in this market. We've seen it now year to date. We've seen it over the last quarter. Encouragingly, it is really broadening out. You hear the term breadth and increased breadth and better breadth all the time. We're really seeing it in industrials, basic materials, joining in with technology. So that's a positive. If we're going to look at what is concerning, there are sectors and securities that are going to have to really fight through these higher rates. You know, that's a cost of capital. That's a cost to the balance sheet. So in terms of where we're trying to identify and focus our capital, it's going to be in areas where sectors are not dependent on going to the market to raise capital. We've talked about that for a while. We were hopeful that by now, maybe we'd start to moderate in rates. Not seeing it yet. In my own guess, we're probably 80, 90% there, but it's going to take some time. This inflation is very sticky. We said last year, once out of the box, it's tough to get inflation back in, especially with all the capital, all the excess monetary policy push there was in COVID. So let's see what we have next week. In terms of fixed income, we really want to keep our eye on that 4% range on the 10-year. Let's shoot over to the Moose, who's taping remotely this week.
Hi, it's John Mousseau. I'm the CEO of Cumberland Advisors. This is the bond report on July 7th, Friday afternoon, around 2 o'clock. This week, decidedly unbond friendly. We saw the 10-year bond Treasury up about 20 basis points, crept back over 4% to a 4.04. 2-year up a little bit, closed around a 4.93. It's been skirting around that 5% level. We got a very unfriendly bond number out of the ADP report yesterday. They were expecting 225,000 jobs. They printed 497,000 jobs. Big surprise. Remember, ADP is private payrolls, does not include the government. And it is a decidedly poor predictor of the Bureau of Labor Statistics non-farm payrolls, which came out today, and was much more bond friendly, because that number today, where they were expecting 230,000 jobs, they printed essentially 209, so less than expected. The important point about this is that we had 15 months in a row of higher than expected numbers, and this is the first month where the numbers came in less than expected. So decidedly, the job market, at least through those numbers, is cooling a little bit. And more importantly, the past numbers were revised down. So last month was revised down from 339 to 306. And if you look over the last 2 months, they've been revised down about 110,000 jobs. So overall, a somewhat cooling number there. That doesn't change the fact that the Fed is going to probably raise rates at their next meeting next week, and probably a 1/4 point. That would take the Fed funds rate from up where it is now up to 5.25% to 5.5%. If you remember, they paused at the last meeting. What goes forward? Is there another rate hike after this? Maybe. I think the important thing is that what happens to the cumulative effect of these rate hikes and its effect on markets, both for labor as well as prices. We're going to know more also next week about CPI and PPI. Very important because those numbers, as we have talked about often, will be replacing some high numbers from a year ago. So the monthly numbers will most decidedly be less than they were a year ago. That will bring the year-over-year numbers down. After that, we expect those to start to pick up on the year-over-year numbers because there were some very low numbers last summer that will get replaced probably by somewhat higher numbers this summer. But it's important to keep that in perspective. And what we really want to watch for going forward are those 3-month and 6-month annualized CPI and PPI numbers. The yield curve is still very inverted from 2s to 10s. We continue to talk about it. That will not stop the Fed doing what they're doing. But we do think that the CPI numbers should start to show that the economy is slowing down. We hope everybody had a really nice Independence Day weekend, and we will see you next week. Thanks a lot.
Thanks, John. Great info. Everybody enjoy the weekend. We'll see you next Friday.